Welcome to the Canadian Investors course, Session 7. This is the conclusion of the financial planning session. Page 2 contains the terms of use and disclaimer, which we'd like you to read. Thank you. Back in August of 2016, Janet Yellen was trying to jawbone the world into getting ready for her rate increases. She kept promising rate increases but didn't deliver. However, in 2017 she has. She's on her third one, and the second one, there's a full expectation that she'll probably give us a third rate increase this year. In this segment, we just in the commentary, we alluded to the fact that it's important to find a financial planner who can talk about insurance in their planning process, because otherwise their plan will not be complete. In this session, we're going to discuss insurance, we're going to discuss various savings programs and products, and some tax-saving financial plan products. First of all, insurance. Insurance really has several branches. It has insurance salespeople can sell term insurance, which is pretty much temporary insurance, and they can sell whole life or universal life insurance, which are permanent insurance products. They also can sell critical illness and disability insurance and annuities. And these tools all have their proper place. The important thing is to understand which ones you need for your own purposes. So why would you have life insurance? Well, life insurance can be very valuable for a number of reasons. The contract is with an insurance company, which is received in exchange for premium payments. It's a unilateral policy, which means that you can cancel it, but the insurance company cannot. Typically, they provide a lump sum payment known as a death benefit on death of the beneficiaries. But they may also have components where they pay some form of payment through the life of the insured, for example, in the case of a disability policy. Typically, life insurance is chosen based on the needs and goals of the owner. Life insurance is used to pay final costs. You can use life insurance to pay the final expenses, including funeral and cremation fees, medical bills not covered by health insurance, estate administration fees, and other unpaid obligations. Paying taxes the estate owes federally and provincially is also sometimes pre-planned using life insurance, and it can be a very economical way of achieving that goal. Life insurance is sometimes used to pay off debts or to replace income. Sometimes it's used to provide guaranteed inheritance, and some people use insurance as an economical means of providing charitable contributions, because you can create the insurance policy while you're alive. The charity knows it's going to receive the money. Its cost to you through your life is relatively small, and the charity gets a large sum upon your passing. It's an attractive solution for everyone. So let's talk about the different types of insurance. Do we want term or permanent insurance? Term insurance is purchased by people who need life insurance to cover a specific period of time and a specific dollar amount. A classic one is a family gets 20-year term to take care of to make sure that their children will be taken care of while they're small and until they're grown up. This type of insurance provides coverage for a set period of time for a fixed rate payment, usually monthly, payable over the term of the policy. When the policy expires, the previous rate for the insurance coverage is not guaranteed and is subject to new payment terms and conditions. If the policyholder dies during the term of the policy, death benefits paid out to the beneficiary. Term life insurance is one of the least expensive methods of buying life insurance to provide substantial death benefits for a given term period. Term insurance comes in either 5-year terms, 10-year terms, 20-year terms, and occasionally 30-year term. 10 and 20-year are the most common in Canada. Then, in addition to that, some of the policies are renewable, and automatically renewable at given rates, and some are convertible too, so they can convert into another insurance product. So renewable term life insurance automatically renews at the end of the term. For a 20-year term, the insurance would automatically renew in year 21 for another 20 years. And the renewal may be subject to higher premiums, usually predefined. But they can take account of age and health problems and so forth. The second type of insurance to consider is convertible term life insurance. And this is term insurance that can be converted to permanent insurance up to a certain age. This is a good feature to have because typically it doesn't require a medical exam. So it's a way of being able to have insurance that can have more value. If suddenly it came across an illness, it wouldn't be pre-existing to the policy. And therefore, if the insurance is convertible, it's a way of being able to obtain permanent insurance when later down the road, because permanent insurance is much more expensive than term. One of the things you want to be on the lookout for is mortgage or creditor insurance. It's typically sold by the bank when you get a mortgage. They say, "Oh, would you like mortgage insurance?" It looks like a good idea, but it doesn't tend to be a very good form of insurance to have. The good news is that if you do buy term insurance through the bank, because it's a unilateral policy, you can cancel it at any time. So if you've done this, you should check with your trusted wealth professional and see whether it's the valid way to insure yourself. Probably isn't, because it almost always is better to go and get your own term insurance rather than to use the bank's. The main reason being that when you buy mortgage insurance, for example, you pay a certain premium based on the original amount of the mortgage, but the mortgage is a shrinking debt. And so near the end of the term, you'd be paying way too much for that type of insurance. So at the beginning, it may look like a good price, but you have to make sure that you understand how it's going to work over the term of the policy. Term insurance is almost always less expensive. By the way, as an aside, bankers and mortgage brokers are not licensed insurance advisors. Typically, they're selling the mortgage insurance because they have an obligation to present it to you from their institution. Permanent insurance, the basic features of permanent insurance are that it provides lifelong protection and the ability to accumulate a cash value on a tax-deferred basis. Permanent life insurance has several variations. Whole life, universal life, and variable life are all permanent life insurance products, and they're all designed to provide insurance protection for your lifetime or as long as you keep the policy in force. They have level premiums. Premiums typically remain level over the lifetime of the policy. Most of them have cash surrender values. That's the value you could accumulate if you took it out today. There's a non-forfeiture option, and you can choose. These are choices available to the policyholder if he decides to discontinue the premium on the policy. And then there are participating policies and policy dividends. Participating policies almost don't exist anymore. They were in when all the mutual funds, when all the insurance companies demutualized, the participating policies almost all went away. But most policies, the whole life policies, do pay dividends, and they're declared annually and paid to the policyholders. And those dividends can be the thing that makes the insurance really good value under certain circumstances. Non-participating policies do not share in the insurer's earnings and don't receive dividends. Term to 100 is a form of permanent insurance that does not provide or accumulate any sort of cash value. The different types of permanent insurance are whole life, universal life, and term 100. We've gone over it briefly before. There's a really good breakdown on slide 10 that describes these, and I'd suggest you read that and refer to that, because that's really the basis for insurance and the stuff that you need to know. These definitions here on this page are general in nature. And these are different customized versions of these types of policies. So if you go to a licensed insurance professional that can properly serve you and provide a proper financial plan, it's a great way to define what you actually need. Other forms of insurance that people look at sometimes, depending on their needs, are critical illness insurance and disability insurance. Critical illness insurance helps you when you have costs associated with life-altering illnesses. You become sick with an illness covered by your policy and survive the waiting period, you'll tend to receive, with most policies, a lump sum cash payment. And unlike reimbursed health insurance benefits, you decide how to spend the money. Once the money's spent, it's gone. It's a great short-term solution. The other type of insurance that you'll see sometimes is disability insurance. People want coverage for if they can't work for some reason. It's very important, if you're going to get disability insurance, to get the expensive version, which is the one that covers your own particular occupation. So that's called own occupation disability insurance. It's the only form of disability insurance really worth having, because there are so many outs for disability insurance that without that, chances are somebody would get hurt and they would decline to pay and get away with it. Let's look at annuities now. These are sort of like a do-it-yourself pension plan. An annuity is a contract with a life insurance company. You deposit a lump of money, they agree to pay you a guaranteed income for a set period of time, typically the rest of your life, and they're very often used to generate retirement income. Annuities can be a really good retirement choice for many Canadians, but not that many people look at them. Like defined benefit pensions, they provide guaranteed income for as long as you live. But while the employer defined benefit pensions are considered to be the gold standard of retirement income plans today, few Canadians ever think about annuities. Annuities are the most effective safeguard against longevity risk or the possibility of outliving your wealth. It's hard to use terms like peace of mind and satisfaction with non-guaranteed investments like stocks or mutual funds. So there are good reasons for retirees to give annuities more consideration. Unfortunately, while the concept is simple, you hand an insurance company a lump sum in return for predictable cash flow, the details are complicated. Hopefully, we can provide you help to determine if annuities are right for you. If there's no chance that you'll run out of money, annuities are probably the wrong choice. They make little sense if you can have an ample employer position, since you are already you already have the assurance of a life, an income for life. Nor are they attractive if you're in poor health. The best payoff from an annuity comes from living very much longer than the average. You can buy an annuity with money from an RSP or a RIF or a non-registered account. The money is returned to you with interest in regular payments. You quarterly How annuity payments work. Your annuity income is calculated when you buy the annuity. It is affected by a number of factors, the most important being interest rates and how long you're expected to live. Once you buy an annuity, you can't make any changes to it. It's locked in. Your regular payment amounts are locked in other words, and you can't change them for any reason. If you're over age 65 and you do not have a company pension plan, you may be able to claim the pension income tax credit. This means you won't be taxed on the first $2,000 of annuity income each year. There are two types of annuities: term certain annuities and life annuities. Term certain annuity is one that gives you a guaranteed regular income for a set number of years, which is the term. Term certain annuities bought with money from an RSP or a RIF must extend to age 90. If you die before the end of the term, your payments will continue to go to your estate. An example would be a 10-year term certain annuity. Annuity payments are for life, however, payments are guaranteed for 10 years. If you die early, the estate will receive the remainder of the 10-year payments. Life annuity gives you a guaranteed regular income for life. Payments are usually stopped when you die, and no money will go to your estate. You may choose to add an option that allows your spouse, beneficiary, or estate to continue to receive your payments after your death. An example would be to set up a joint last to die annuity. The spouse receives payment after the first spouse dies. You can have annuities deferred or for immediate payment. With a deferred annuity, your money is invested for a period of time until you're ready to begin taking withdrawals, typically in retirement. You might be 58 years old and you decide to buy an annuity where the payment will start at age 65. If you opt for an immediate annuity, you'd begin to receive payments soon after you make your initial investment. If you buy the annuity with pre-tax money, then the entire balance would be taxable. This occurs if you transfer money from an RSP or a RIF to buy an annuity. If you use after-tax funds, then you'll be taxed only on the earnings. Part of your monthly payment is actual principal, so not all income is taxed. This is what makes annuities in tax-paid accounts so advantageous. If you cash out a deferred annuity in a lump sum, you'll have to pay income tax on all the earnings higher than your original investment. Variable pay annuities also exist. While most common types of annuities offer fixed payments for life, you can also get variable annuities, which offer the possibility of increasing payouts if stock and bonds markets perform well. Your money goes into a segregated mutual funds, but there's a trade-off. You get upside potential if the markets do well, but minimum guaranteed income is substantially less than you'd get from conventional fixed annuity. Variable annuities, which include products such as Manulife's Income Plus and Sun Life's Elite Plus, were all the rage a few years ago. They promised a guaranteed minimum withdrawal benefit, GMWB, of 5% in their heyday. But once critics argued increasing payouts were unlikely because of rigid rules and excessive fees, around 3.5%, as interest rates declined and the financial market crashed 2008-2009, they fell very much out of favor. In fact, this affected the financial shape of Manulife because the shrinking portfolios gave the insurance company lower fees and as a result caused a strain to keep paying the 5% on the original principal of the annuity. Now these annuities are currently available. Now these annuities, which are currently available, charge much higher fees and pay lower guarantee percentages, like 3.5% to 4%. The portfolios tend to be made up of balanced funds or growth and income funds, and this makes sense since it would be risky to put the money 100% in the stock market for somebody who is in their 70s or 80s. But this is also where the problem lies. If the portfolio is laden with bond funds, then the fees could kill the return because today's yields are lower than the internal fees charged on the investment products. This leaves the stock or equity side to carry the load, which doesn't make sense. This variable annuity argument is definitely understood by an IROC licensed full service advisor. It really behooves you to contact a trusted wealth advisor, your trusted wealth advisor, to get good advice if you have products like these. The good news is that some of the existing products, if you purchased one of the early style annuities, either from Manulife or Sun Life, they may be a very good investment, so you may not want to dispose of them, but you certainly should understand them. Let's consider various savings programs and products. Government created or sponsored savings plans include RSPs, which is a registered retirement savings plan, RIFs, registered retirement income funds, RESPs, registered education savings plans, TFSAs, tax-free savings accounts, RDSPs, registered disability savings plans, IPPs, individual pension plans, and RCAs, retirement compensation agreements. Lots of acronyms. Registered Retirement Savings Plan is an investment account registered with the federal government, is generally used to save for retirement. It's probably the one real tax break CRA gives you, so it should not be ignored. RRSPs have special tax advantages. First of all, contributions are tax deductible. That's the most important part, is the immediate tax relief you get by making RSP contributions every year. Then the earnings inside the RSP are tax sheltered for as long as they're in the RSP. They only pay tax on them once they're withdrawn. So that gets us to the tax deferral component, and that's that the earnings are tax sheltered while they're in the plan. Then you pay the tax on them when you withdraw them from the plan, which presumably is going to be when you're retired. But the idea is that you defer this tax liability to the future when it's possible that your marginal tax rate may be lower than it was when you were earning the money. Of course, it's a good problem to have if your marginal tax rate is just as high in retirement as when you were working, because that means you have so much income. So that wouldn't be such a bad thing. Anyone who files an income tax return and has earned income can open and contribute to an RSP. It has to be defined as pensionable earnings. The contribution limits are the lower of 18% of your earned income in the previous year, or the maximum contribution amount for the current tax year, which for 2017 is $26,010. If you're a member of a pension plan, your pension adjustment will reduce the amount that you can contribute to your RSP. If you have a group RSP, that's also going to contribute to your pension. Well, that's not going to contribute to your pension adjustment, but if you have any kind of a pension plan, even defined contribution, it will contribute a pension adjustment, which will reduce the amount you can contribute. And if you have unused contributions from the past, you can carry them forward into the future and use them sometime in the future. As well, you can make contributions to your RSP now, and if you're thinking you're at a low income level and your income level is going to grow, you could make the contributions today, but not take the deduction for them. In other words, not take the tax break for them until you earn a higher level of income, perhaps sometime in the future. Registered retirement savings plans can hold a whole collection of investments. They can hold cash, gold and silver bars, GICs, savings bonds, T-bills, bonds, mutual funds, ETFs, equities, Canadian mortgages, mortgage-backed securities, income trusts, and even the mortgage on your own house. The only issue is that not all advisors can do that. Fewer and fewer firms will allow you to put your own mortgage into your RSP, but that's technically still allowed under the rules, and precious metal certificates. You can open an RSP account in a bank or in a trust company, in a credit union, at a Caisse Populaire. You can open them with mutual funds companies. You can open them with IROC licensed firms or MFDA licensed firms, and with life insurance companies. Now, registered retirement income funds, really all they are is the evolution of a registered retirement savings plan. So when you turn 71, the money that you have in your RSP must either go into an annuity or into a registered retirement income fund, a RIF. So when people say, oh, I have to go into a RIF, and they're worried about it, in actual fact, there's not much to worry about, because most of the investments that you can own in a RSP, you can also own in a RIF. So chances are it's just an administrative change. RIFs provide a high level of control over the investments in your retirement plan, the advantage of tax-free growth assets within the plan, as well as maximum flexibility in establishing an income stream. You can only hold an RSP until you're 71, as I said before. At this stage, at that point, you have to cash it in and either buy the annuity or the RIF. With a RIF, you can customize the payments. Some people want monthly or quarterly payments. Others take the income once a year, usually at the end of the year. You do have to take a mandatory annual minimum payment, but from there on, you can take as much as you like. If you look at slide 18, there's a table that lays down the minimums that you have to take out of your RIF at any given age. So something important to consider is that when investing in an RSP, don't get talked into having all your GICs mature the year that you open your RIF. First of all, this is not smart. Secondly, it's somewhat tragic. Many RSP holders in the late 1990s and early 2000s held their RSPs at a bank and would have GICs set up in such a way so that most or all their money came due after 2008 when interest rate collapsed. They went from 5 or 6% to 2% right away. That was tragic. If you're going to have a GIC portfolio, make sure that the maturities are laddered out so that they don't all mature at the same time. So strip bonds in the past have been very popular RSP investments because they offered government guaranteed compound returns. You could have laddered your bond maturities over a 20-year period and so on, but today there are very few strip bonds, so it's really not a relevant thing to talk about. You can set up self-directed RSP or RIF with a discount broker or a full-service IROC broker or an MFDA person. But if you're doing this for the first time, make sure that you set up meetings with more than one advisor so that you'll get different perspectives. Ideal thing to do is to have the same list of questions and ask the same questions of everybody so that you get a fair idea of who's doing what. Don't become a victim of an advisor who's going to handcuff you by lack of choice and flexibility in your investment product. Let's move on to an RESP, Registered Education Savings Plan. These are intended to help parents save money for their children for higher education after high school. Most RESPs are open for children, but you can open an RESP for yourself or another adult as well. The person who opens the plan is called the subscriber. When your child enrolls in post-secondary education, they can start taking payments called educational assistance payments from their RESP. EAPs are made up of the investment earnings and the government grant money in the RSP. The person who's named to receive the EAP is called the beneficiary. So here are some of the key features. First of all, the most interesting feature for most people is the fact that when you make a contribution to an RESP, the first up to $500 a year is subject to a grant of 20 cents on every dollar you contribute. Sorry, up to $2,500, which means that you can get a maximum of $500 in grant money into your RESP. Many people will make the RESP contribution of $2,500 a year just to make sure that they get the grant money. But you can contribute up to a maximum of $50,000 to an RESP over the life of the plan. So another strategy to use if you have plenty of money is to make a large contribution at first and then just make $2,500 contributions each year afterwards to maximize the grant contribution and to have as much money as possible in the RESP to grow for the longest period of time possible before the student goes to university. If this sounds too confusing, talk to your trusted wealth professional to get that clarified. But the bottom line is there are a few rules about RESPs. First of all, the EAPs are taxable in the hands of the student. That's very valuable because it means that the money goes into the RESP tax paid, but it comes out taxed at the lowest possible level, which is in the hands of the student who probably has next to no income. There are a variety of investment options, many basically similar to the ones that are allowed in an RSP. Friends and family can contribute. The main thing is that an RSP account can only stay open for 36 years, and the grant can only be received up to the age of 17. So who offers RESPs? Well, just about everybody. Banks, credit unions, mutual fund companies, investment firms, and trust companies. They offer individual and family plans. If you only have one child, you can have an individual plan. If you have more than one child or think you will have more than one child, you should probably open a family plan. As I said before, you can put a maximum of $50,000 per beneficiary into each plan over the life of the plan. So that's why it makes sense to look at that strategy that I mentioned earlier. A family plan can have more than one beneficiary, and the money can be drawn out for the use of any one of those beneficiaries. You don't have to make a minimum deposit when you open the plan. You can decide how much money you want to put in, and you can divide the funds amongst the beneficiaries any way you need to. And so it's a good way of putting more money into the plan, and if one of the beneficiaries is not going to use the money, it can be used for the other ones. As well, if there's money left over near the end, it can be drawn back out and recontributed to the contributor's RSP if there is room. You can there's actually 4 options. You can keep the RESP open because it can be open for up to 36 years. They might want to continue their studies later. Money can be transferred to the beneficiary. You can transfer it to your RSP if you have contribution room, and you can do up to $50,000 tax-free, or you can simply close the RESP and wind it up. The government grant money has to be paid back to the government. The rest of the money, it's yours. You can keep it because it was already tax paid. You'd have to pay any taxes on it in the hands of the beneficiaries, however. The TFSA is the other contributory plan, which is a real benefit from the government. The annual contributions for 2016 are $5,500. Previous contributions limits were $10,000 for 2015, $5,500 for 2013 and 14, $5,000 for years 2009 to 2012. The limit for 2017 will be $5,500 again. So the bottom line is that if you have not contributed to a TFSA from the age of 18 for all of these years, then that means that you can contribute all of that money to the TFSA at some point, and you can invest it in almost the same products that you could buy within any other registered plan. So there are people who have room to contribute $35,000 and $40,000 to their TFSAs at this current time. RDSPs are registered disability savings plans. These are intended to help disabled people, and for every dollar that's put into an RDSP, the federal government can, if your family income is below $87,123, contribute up to $3. This is the Canada Disability Savings Grant. For people living on a low income, in other words, less than $25,356, the federal government will put in $1,000 each year for 20 years. This is the Canada Disability Savings Bond. For people living on an income between $25,356 and $43,561, they can still receive a partial bond. Now, once you've decided to open an RDSP, you must find out if you're eligible and what's required. So you have to become eligible for an RDSP, you have to open the plan, and then you have to manage your money. There are 2 groups of people who can open this account. The first is individuals who with disabilities who are opening the RDSP for themselves, and family or friends who are opening it for their son, daughter, or friend who has a disability. Who handles RDSPs? Again, Canadian banks, insurance companies handle these. Mutual funds and segregated funds are most likely the investments that will be recommended. Other advisors tend to not offer this type of account. IPPs are individual pension plans. This is a great retirement tool if utilized properly. The benefits of an IPP are they allow for substantially higher contributions than those permitted under an RSP. The contributions and costs related to an IPP are tax deductible and paid for by the company. These are really a plan intended for entrepreneurs and business people who own small companies and want to fund their retirement plan through the company, and therefore that's how this facility is created. They've got the possibility to contribute for recognized years of service prior to the establishment of the IPP, which means that can put a large amount of money into the plan. And at retirement, amounts continue to grow free of taxes if the annuity is paid out of the plan. In the case of plan termination, employment termination, or retirement, the surplus can belong to the participant and is not taxable as long as it is not withdrawn. Upon retirement, the surplus can provide additional income to the participant, can transfer to a life income fund, and the possibility of the IPP provisions in order to maximize the benefits for the following situations: indexation of annuity, early retirement without reduction, and a bridging benefit. The funding of these benefits is known as terminal funding, and it results in an extra contribution which is also tax deductible to the company. Used properly, these are a great tool. RCAs are retirement compensation accounts. This is another tool which independent business people can use. It allows 100% tax deductible corporate dollars to be deposited into an RCA on behalf of private business owner and or key employee. No tax is paid by the owner or employee until the benefits are received at retirement. So it's a deferral of tax again. And a normal level of benefits would be the same benefit provided under a registered pension plan without regard to Revenue Canada maximum. This would be 2% times years of service times final 3-year average earnings, or about 70% of pre-retirement income for an employee with 35 years of service. So if you want to know about RCAs, you've got to talk to an advisor. This is too complicated it's beyond the scope of this course. Both IPPs and RCAs are excellent savings tools. They definitely require a trusted wealth professional and rules-based investing mirrors prescribed growth rate mandated by the IPP enactment. This is very important for business owners section of this website as detailed information and additional presentations. Please enter your postal code in the entry box at the bottom of this page to find an IPP or RCA specialist in your area. That's the end of segment 7.